First off, for those that just logging in, today we're hosting my friend and colleagues, Matt Burk, who's CEO and president of Verivest, and also Chris DeLap, who is the COO of Verivest. Matt, Chris, hey buddy, guys, thanks for coming on today.
Yeah, thanks for having us.
Yeah, so I know we've been trying to schedule this event for a while. As I talked to you, we host these monthly webinars for investors and others in the fund industry and mortgage fund industry to kind of dive into what I don't think a lot of people understand or know about the fund industry. So Matt, I know you've been on the road a lot, so I'm glad to have you on. And we're going to really dive into the role that a fund administrator plays in a fund, and it's huge. I don't think we could have been successful, or we could be successful today without having Verivest, our fund administrator, involved in the day-to-day activities such as the accounting and other things that you guys are handling for us. So thank you. In just a minute, I'm going to give you guys an opportunity to introduce yourself, but there's just a couple of housekeeping items that I want to go through. For those that are on but may want to watch this webinar in the future, we're going to go ahead and record it. We'll go ahead and post the recording of the webinar on the TaliMar Financial YouTube channel. Also, we'll share a copy with Matt and Chris so they can send it out as well. If you've not been on the TaliMar Financial YouTube site, definitely check it out. We posted all of these webinars on the site. We also posted a ton of other great content, about investing in trust deeds, about mortgage funds, the market, the industry. So go check that out and make sure you give some likes to those videos. Do want to jump out with some disclosures right off the bat. We're going to cover a couple of topics in this webinar that should be used for informational purposes only, shouldn't be construed as legal, financial, or professional advice. Recommend consulting a qualified attorney or other relevant professional regarding the topics we discuss. Look, at the end of the day, I'm not an attorney, I'm not an accountant. And so go ahead and talk to people that are professionals in those industries. So with that behind us, Matt, Chris, thanks again for coming on today. Starting with Matt, go ahead and give a background. Let everyone know who you are, what is that you do, because it's interesting. You've been in the industry for a long time.
Yeah, I'll give you a quick overview of a 30-year career, Brock. But I started off really. I did what you're doing. I was a private lender for many years, doing first trust deeds secured by commercial real estate.
Yeah.
Originating those loans one at a time. In about 1999, 2000, we were matching investors up one at a time. We decided to start our first fund. So I went through the process of setting up a 506 Reg D fund, learned a lot of lessons, ended up doing fund 1, 2, 3, 4.
And that was early on in the process. It's not as big as it is today.
Yeah, no, there was far fewer resources. Of course, the internet was just in its infancy. I mean, it was old school, man. I don't want to give, age myself so much. The upshot is, I've been doing funds for a long time, so I understand. I come at it from a practitioner's perspective. That's really how we got started in the admin business. Ultimately, coming out of the Great Recession, as we were winding down our then largest fund, which we ended up doing successfully, I had people asking me questions about running funds, and so long story short, we started doing some advisory work, helping people think through and trying to avoid a lot of the mistakes I avoided and bringing value of the learning experiences that I had. So since that time, we've played the lead role as a business advisor for a lot of fund managers over the last 10, 12 years, 300-400 of them at this point. And that's really what gave rise to the admin business. Once they launched the fund, a lot of the managers were like, well, now I'm not really sure how to do the back office accounting, the allocations of income and interest. And I got multiple deals coming and going at different points in time and investors coming and going. So we started doing the admin about 2013. And we were doing that at our investment company at the time. We spun that out as a separate business in 2017. And that was really what gave rise to Verivest. We've grown from really nothing at that point, to about $3 billion of assets under administration.
Wow.
And have worked with lots of folks like you guys to try to help as best we can and watch you grow. So admin, we'll get into that, I'm sure, but that's my background. I'm really a fund manager. turned advisor and administrator over the last 7-8 years.
Great. Hey, Chris, what about your background?
Yeah. Well, I'm the COO here at Verivest and head, everything operational. That includes our fund administration team that provides the services to fund managers like yourself, Brock. I have been in the financial services industry for over a decade and initially started at a global RIA firm, building their client services groups out within the UK and Canada, and then moved into the real estate space, fundraising space, really focused on raising capital for fund managers on a crowdfunding platform, and built the operations for that, and then moved over to Verivest. And really my focus here has been, to streamline our processes, workflows, and be able to deliver our services as best as we can to fund managers.
Yeah. And Chris, thanks very much, Matt, as well, for giving some background. And I got to say that the industry for mortgage funds has exploded in probably the last, 5 to 7 years. And I think there's, and we're not just talking about like mortgage funds. I think just funds in general, real estate funds, and maybe funds outside of real estate. You've seen a considerable jump in the number of funds that are being established. Would you say that?
Yeah, no question. I mean, the mortgage pool industry, private lender industry has grown dramatically since I started doing it. And you're seeing it even private equity, private credit. I mean, just alternative investments and private funds in general, right, have gained a lot of traction over the last 5 years. And you're seeing a great deal of capital flowing into the private side, coming out of the Great Recession, a lot of what happened with the banks and so forth. So yeah, the private fund industry has really grown, and all the projections I see say that that's going to continue to happen.
I'd agree, and we're going to get into some of the questions that I have for you, but one of the stuff that I was kind of impressed with Verivest, because there are a number of fund administrators out there you can choose from, but the industry is changing so rapidly from even when we launched the fund in 2021 to kind of the technology that's available to it. So Chris, I imagine, you're sitting there just trying to figure out what's the next thing coming down the pipe that you guys have to add to the platform or adjust for or whatnot.
Yeah, and I think that one of the things that we're lucky to have is that we were grown out of a real estate fund manager. So someone that's been through the ups and downs of the market, have, kind of guided us with their needs and wants along the way. And so I think we have a really solid foundation. But yeah, keeping up with how the industry is changing, the different things the SEC is focusing on, it's really important that our fund administration team stays on top of understanding what those new regulations and compliance aspects are, for sure.
Yeah, 100%. So, so as we get started with the questions, as I always say in front of these webinars, is number one, we love questions. This is an opportunity for the attendees to ask two very knowledgeable people about fund administration. So please ask questions. It's much easier if I can get some feedback from you to and respond to those questions. Then I can kind of focus on the questions that you guys want to hear. So use the question button. I think for most of it, it's at the bottom. For others, maybe on the right-hand side. And I'll go ahead and manage those questions, Chris and Matt. And I always say that, look, there's no question too easy. The easier the question, the easier it is for us to respond to. So keep those questions easy as well. But let's go ahead and get started. Let's just start from the top. I'll throw it to you, Matt. Can you just quickly give me an idea, what is a fund administrator and kind of what role do they play for within a fund?
Yeah, fundamentally, a fund administrator is doing the financial work on behalf of the fund. So it's a third party that gathers the information, coordinates with the manager to produce financial information on the fund, allocate the investor profits and losses according to the operating agreement, basically makes sure that all of the rules of the road as written in the operating agreement, the limited partnership agreement, are being followed when it comes to how you allocate income and produce all of the financials. There's certainly more. There's ancillary services that a lot of admins have, and Chris can get into some more of the specifics around it, but providing valuation services when you're calculating net asset value and share price calculation, which can become very tricky for a lot of managers. And at the end of the day, Brock, I think for a lot of mortgage pool managers and fund managers generally, their expertise lies in asset origination, acquisition, management, et cetera, not necessarily pooled fund accounting, right? And in the institutional world, when we've got large institutional investors, pension funds and so forth, a manager having a fund administrator is an absolute requirement. I mean, it's not optional; it's a requirement. As you get into the family office and the high net worth investors, I'd say it hasn't historically been as common. It's not an absolute requirement from the investor side, but increasingly, I'd say you asked a question a bit ago. One of the things we've absolutely seen the last 5-10 years is more and more investors wanting to see a fund administrator on behalf of that manager, because it's another set of eyes that's making sure things are done properly, and it dramatically reduces the chances of bad things happening. When you've got the manager just doing all of calculating all of the numbers on their own, many times of which they're not necessarily experts at that. So fundamentally, that's what an admin is.
Yeah, and I agree with you, because a common question that I get from investors is, who does your accounting? And we've all heard about the horror stories of a fund admin or fund manager running away with all of the money, or not managing the fund appropriately. And when I can say, hey, I use a third-party fund admin that specializes in the mortgage fund industry, it puts that question to rest. I mean, just a quick answer there, and you can kind of move on to the next question. So I would agree with you that fund admins add just a higher level of transparency in a fund.
That's right. That's exactly right.
So Chris,
I think the thing, Brock, I would just add there is, I think because fund administrators are focused on accounting, and that's, what they're breathing in and out every single day, it really allows the fund manager to focus on what they do best, which is either dealing with the real estate or managing their loan portfolio or whatnot, and they can lean on that fund administrator for their expertise and guidance. So I think the transparency, but also just being able to take that off the plate of a fund manager so that they can do what's best for the investors is a critical aspect.
100%. So, I mean, in general, then how would you, if someone were to ask, how is it different than an auditor or an accountant? How does a fund admin differ? And I'll give that Chris question.
Yeah. I mean, I think it's very important that fund managers also have an auditor or CPA as a part of their third-party relationships. But ultimately, what the fund administrator is doing is quite a bit different. So as Matt alluded to, we're producing the financial package on a regular basis. We're producing the investor statements and helping those investors into the fund and out of the fund, et cetera. Whereas an auditor is taking the information that we are doing on that regular basis and comparing it to the legal documents to make sure that we're adhering to the structure of that fund, and that the way that the manager and the fund administrator are reflecting the financial situation is consistent over time, and then producing that report for investors. And then a CPA is more taking the information that the fund administrator is producing so that they can prepare things like tax returns and the investor K1s, et cetera. But the fund administrator has a strong relationship with both of those parties.
Yeah, and they coordinate. So as we have every year we have an auditor, a third-party auditor that comes in, and actually gives me comfort that we have a third-party auditor coming in and looking at your work to make sure that what you guys are doing is correct.
Yeah, and a lot of times what the admin is also doing is helping to mitigate the cost of the audit, because a lot of the information that we're providing up front, we do audit prep work, provide the information to the auditor. Ultimately, the auditor's there to, and as you know, Brock, they don't review every single transaction, but they'll flag, they take the information, they'll flag high risk looking things, and they'll do a spot checks to verify, and they'll get corroboration of certain things from third parties and counterparties and things like that, right? At the scope. So there's a very close relationship with an admin and an auditor. In fact, one of our biggest referral sources back and forth are auditors and CPAs because, we work so closely with them.
I'll say that when we did our, you hit on a subject that's important, because when we did our audit last year, the ability to consolidate, have the information available to pass along to the auditor saved our team a considerable amount of time and effort to do it, just to be able to, hey, this is what I need, and then pass it on to the auditor. So I would agree with you. And it's also done in a way that the auditor understands it and feels comfortable with that information.
Yeah, because I mean, auditors will tell you a lot, right? When they what they don't want to have is the metaphorical shoebox full of receipts, dumped
Yeah,
on them at the end of the year, and they got to try to sort through it, right? If you're doing it with the admin, you know exactly what they want. You're doing it on a regular basis. The cadence is happening on a monthly or quarterly basis, and then it's just so much more seamless when you do it that way.
absolutely. All right, Matt, next question for you here. Now we talked about, we're a fund, we're a debt fund. Verivest is a fund administrator for us, but there's fund administrators for all different types of industries. We kind of hit upon this a little earlier. So there's real estate funds, hedge funds. How does that differ? Like, how can you kind of be specialized in everything? And are you specialized in everything?
Well, the answer to the first question is it's difficult. I mean, obviously, the bigger an organization gets, the more they can have various verticals, right? That they have people applied to. I characterize us as a boutique administrator.
Okay.
So we definitely focus on mortgage pools and real estate and private credit. That's our strong suit. We also do some private equity, not so much on the VC hedge. So there's all kinds of different funds, right? Real estate, private equity, oil and gas, private credit, hedge funds, long short hedge funds, right? So there definitely are different administrators that are stronger or weaker in different verticals. So that's a great question for a manager to ask is, what is your specialty? How do you do that? Who's dedicated to it? What teams do you have, dedicated to any particular vertical, et cetera? Some of them, it's not even so much always the asset class, Brock, as it is the structure of the fund,
Oh,
right?
interesting. Okay.
Like in private credit, for example, it's if the asset is a piece of real estate or the asset is a company, right? The nature of the instrument, the loan, is exactly the same. The difference comes in things like valuation, right? If there's impairment on the asset, when do you recognize it? How do you calculate impairment on a trust deed versus a business? Things of that nature. And a lot of this kind of stuff gets very technical, not necessarily readily obvious to the average high net worth investor as to how this stuff is done. But a good administrator understands this intimately, right? And is applying, GAAP-based rules and common acceptable approaches to valuation and so on and so forth. So again, it goes back to giving comfort to the investor that things are being done the way they should be done.
And they offer guidance to the fund manager too on questions.
No, absolutely. I mean, because it'll happen, right? Let's say a borrower stops paying on a loan, right? You're not sure of the value. How do you value that loan? And it may only be one loan in a pool of 10 or 20 or 50 or 100 loans, but depending on the size of that loan, I mean, your responsibility as the manager in order to determine the share price that the investor is coming in at is to make sure that loan, every loan in that portfolio, is being valued appropriately. Well, how do you know when the borrower no longer is paying and you're maybe in a down market where you're not sure what the value of that property is? Right? You have to make and those judgments can be very subjective, right? And a lot of times that, a manager's natural tendency and incentive is not to necessarily recognize that impairment because it might negatively impact the return of the share price, which is a hard conversation to have with an investor.
Well,
right?
you bring up a good point because now there's some significant new guidance on how you have to necessarily set aside a loss reserve, especially in the debt industry, being appropriately put loss reserves set aside. So
that's another thing. That point you just made there, Brock, is like there's constantly evolving regulation and guidance around how you do these things and requirements, right? That not necessarily, you're busy every day originating loans and underwriting loans and collecting on loans. You're not necessarily paying attention to every regulation that comes along and how these esoteric treatments need to happen. So having an administrator that is paying attention to that provides a tremendous amount of value to the manager and to the investors to know that it's being done right.
Absolutely. So a couple questions popped up. So what's fun about this webinar is we both have fund managers on this webinar and investors as well. So these are actually a couple of questions from fund managers. So number one, first question is, does Verivest set up everything for a fund, specifically for a real estate fund? And I imagine when they say set up everything, all the fund documentation and whatnot.
The answer is no, we do not. We're not lawyers, so we do not draft legal documents. And I tell every fund manager out there, you need to have a high quality set of legal documents prepared by a securities lawyer. But that said, we do offer advisory work, business advisory on, okay, you're thinking about setting up a fund. How might that fund look? What is your asset model? Who is your investor base? How much money do you think you're going to raise? What kind of fee structure might you want? These are business questions that the manager needs to consider. We can help with that. We also can help introduce formation lawyers. We have a very close relationship with at least 8, 10 different law firms who specialize in fund formation that we could make that introduction for you. And oftentimes that, Brock, depends on, okay, size, location, deal type, et cetera, as to who we think is a good match. So the answer is no, we don't set it up in terms of drafting the document, but yes, we can help make sure that you're doing it properly and introduce you to the right service providers and so forth.
Absolutely.
And I think, Brock, just really quick on that point, I think one of the things I would add there is just that if you do already have your fund documents drafted and whatnot, a part of our job is to be experts in reviewing those documents. And oftentimes this happens almost every time we're onboarding a new fund manager. We'll catch something that's like, the way you have this structured is going to be a nightmare in terms of how doing the accounting. Here's how we might suggest you change that to make it a bit easier. So our goal here is to really act in partnership with the fund manager, even if they already have their fund set up.
You bring up a good, I was going to say that. I was going to bring up a good point. I almost equate it to like the architect and like the contractor. Your contractor is like in real time, like this really is going to work, but the lawyer isn't the architect thinking these great ideas and how it's going to work and waterfall distributions. And you guys are on the front lines going, no.
Yeah.
And look, ideally, the architect and the contractor have a good relationship with each other, and there's back and forth and give and take there, right? And look, we don't. If somebody already has a lawyer, that's great. We're always happy to get involved and have that conversation to come up with something that's going to be workable. Because I can tell you, Brock, having done this, I've set up 300-400. I've played the lead advisory role, me and the team, for at least 300-400 funds in the last decade. It's very, very common that something is kind of off or weird, and we try to help people avoid that going in because it makes your life as a manager way easier from there on out if you've set it up properly in the first place.
So the answer is get them together, all of the parties that are going to be involved early on in the kind of the design and implementation process.
Exactly.
Yeah. All right. So next question here, and again, this let me see if I can kind of twist the question around. The question is, if I have several investors greater than 10 million each, is it better to have a fund or to individually manage each investor? I imagine they're talking about on an acquisition of a real estate, of a property. I mean, I guess you could apply that to debt too. If you're having large loans and you're going to have individual investors on a loan, is better to have one or the other? I would say, honestly, it's dependent upon the situation.
I would say the same thing. I get that question. I mean, I've had that question 1,000 times, and the answer is it depends. I mean, what are your individual objectives? Who are those investors? What type of asset is it you're buying? What are you trying to accomplish with it? So it's all depends on the person, the situation, et cetera. That's exactly when we're doing advisory work. That's the exact kind of thing that we would explore and try to provide, guidance. There is no one absolute right way for everybody, right? Sometimes it's better one way, sometimes it's better the other.
Yeah. And well, let me kind of shed light from this perspective. So when I first started TaliMar Financial, we were doing individual trust deeds, and the average trust deed at the time back in 2008, maybe you've been 200 to 300,000. So you'd have maybe 1 or 2 investors per loan. But as the market, came back in the real estate industry, loans started to get bigger. We started to focus on doing larger loans. We found ourselves having maybe 8 to 10 investors on each loan. And at that point, it just became too difficult, herding cats of trying to get everybody wiring their funds in for the loan and then managing the loan with 10 investors. And that was probably the number one reason we went to the mortgage fund platform from individual trustees, was to essentially consolidate all of the investors and make it way more efficient to actually run a private lending business. And that was our reasoning. And I think we solved that problem. Now, we created not other problems, but there's more complexity on running a fund. You've just kind of shifted your energy from individual trustee investors to now managing a fund. So that's my story of why we made that transition.
That's my story, Brock. In 1998, 99, 2000, I did the exact same thing for very similar reasons to you. The question from whoever that was about, at $10 million a piece, I'd say if you're buying, apartment buildings or industrial buildings or something, and the check size is higher and you're dealing with debt and you're only doing a handful of deals every year, in those instances, it may be easier to segregate each asset, and have, and syndicate them, have, 3, 4, 5 investors per deal. But if you're doing big volume, and that tends to happen in the loan business, I would say it's much easier as people grow and scale. If you reach any volume on origination, funds often make a lot more sense. Not always as much so for individual syndicators who are actually buying property with the investor's money.
Okay. Next question here, and I'm not sure I understand specifically the question, but what's the difference between PL and creating a fund? PL, I'm maybe it's a private offering. PL, if whoever asked that question, if you can define what PL is, I'll get back to that question. All right, so let's get back to some of the other questions that we had. Let's talk about kind of the responsibilities of the fund administrator. We kind of hit upon this, but let's highlight again. What are the key functions of a fund administrator, like from day-to-day functions? And Chris, I'll let you hit this.
Yeah, I kind of bucket it into 3 different areas. So I think that there's, the fund financials that need to be prepared, and that includes, creating the balance sheet, income statement, general ledger, trial balance, making sure we have all the supporting files to actually build that reporting package for the manager. And then the second part of that is what Verivest calls investor servicing. So it's taking what is produced by that fund financial package, what cash is available to pass down to the investors, how does that get allocated to each of the investors, are we accruing the pref, are we able to pay out payments, etc. So doing all of that, generating the investor statements so that they can see what their total return is on their investment, etc. So that's kind of the investor servicing aspect. And then there's this other third bucket that I would say fund managers don't always use the fund administrator for. TaliMar does, which is kind of like this investor onboarding and compliance aspect. So, assisting the investor through setting up their account, signing the documents, running, the anti-money laundering checks, verifying that they're accredited, and just ensuring that they're overall in compliance with what the requirements of that fund are. So that the fund manager can feel comfortable accepting them into the fund. So I would say it falls into those 3 buckets.
Yeah, and I would add too, Brock, that there is other ancillary services in it. From admin to admin, some of this stuff may vary. Some people have it available, some don't. But valuation, determining the net asset value of the fund, running things through the waterfall at the asset level, audit and tax prep work, where we're really truly delivering something to the CPAs and the auditors that make their job easier and save you guys costs. So there's ancillary things that from admin to admin may vary somewhat.
Yeah, and I'll kind of talk about that in real time. So for example, our fund, we push to have figures out to the investors, usually about the 20th of every month. So today, actually, we were given our finalized numbers for October, and now we can distribute those statements out to investors, which, by the way, you guys obviously do a great job, but manage that function of drafting up all the statements and getting those out to the investors. And I'll tell you, my investors want to see that the 20th of every month. So
yeah, and that's a comment. You guys do a good job of providing us the information we need to deliver that financial package. That's always a back and forth between us and the manager. And this speaks to what I was talking about earlier. A lot of times the manager's strong suit is not the accounting side. So to some degree, a lot of our ability to get that out on time is predicated on getting the information we need from you. So there's a lot of the back and forth between us and the client on making sure that we have the information that we need.
Absolutely. So let's kind of hit upon compliance, because that's kind of the thing that keeps me up at night. And I think this is where, from legal compliance to just SEC guidance compliance, stuff that can really trip you up, especially as you grow up a fund. I feel like you become maybe a bigger target as your fund grows. What are the kind of things that you guys see from a client compliance standpoint that a fund administrator, needs to keep a handle on? And I'll kind of jump into one of them because I was speaking at the American Association of Private Lenders, the APL conference last weekend, and I taught a course on fraud. And one of the things, obviously, we talk about fraud in a mortgage fund by the loans, but people don't realize there's fraud that can happen on the investor side. And if you don't know your investor, if you're taking money from an investor that's in a country that's been banned from investing in U.S. assets, again, you can get in a lot of trouble. So kind of what are you guys seeing from regulatory and compliance for fund admin or for
Yeah, I
fund?
can jump in initially and then Matt fill in, but I think the specific example that you're talking about, Brock, a part of what our platform does and what we're checking for is we do those AML KYC checks, accreditation verification, et cetera. And it is our responsibility to, if we see something funky pop up and we can't clarify that, or just disregard that that's not the right person that's being flagged or whatnot, we need to bring that to the fund manager to ultimately make the decision to let them in the fund or not. And I think there's other aspects to it. Even from the fund manager perspective, also not committing fraud is, like I said before, we really do a deep dive into the legal documents to make sure that the accounting is being done with how those documents have been structured and what the investors' expectations are around how the fund should be operated. And even though we're a service provider to that fund manager, our ultimate job here is to make sure that investors are receiving that transparency. So if we, are seeing red flags and we're not able to verify what's going on with the fund manager, we do find it our responsibility to notify the investors of what our findings are. So that's another thing that I would say is it's not just keeping in regulatory compliance with that fund manager and just communicating to the fund manager, but we do believe we have a responsibility to keep investors updated as well.
Yeah.
I would add to that, Brock. I mean, when you talk about compliance, there's compliance all the way from what Chris was describing, the front end, pre-investment, all the way to, post-investment, all the way up to audit. So there's also, FinCEN's got new requirements now about, the BOI of that you have to, who's the beneficial ownership interest. You have to disclose all of that. So there's a lot of stuff that the administrator needs to stay on top of to bring to the attention of the manager. I mean, I could tell you stories of clients we've had where we've brought things up to the manager, and in some cases, managers just don't frankly understand the accounting treatment that's actually in their own documents. And when we point it out to them, they push back on it and insist that it's something different than it is. And we've had to resign as an administrator in certain instances. We've had to notify investors of a manager's, what we believed was the manager's unwillingness to adhere to their own documents. So it's a responsibility to make sure that things are being done properly. And I'd say, there's great managers like you guys that want to do it right. And, and if you don't understand something, you're open to hearing, how it's supposed to be done and verifying that information and so forth. Not every manager is like that.
So beyond just compliance, from investor relations standpoint, again, I mentioned this earlier, is it's probably the top 3 questions my investors ask is hey, how are you doing the accounting? Again, they'll point to, a friend or family member that had got involved in a fund that the accounting wasn't done appropriately. How can you guys help streamline that investor process? So getting statements out. I know you guys have an investor portal too, that kind of, I wouldn't call it white labeling per se, but investors can come in and get their statements on the portal. Chris, maybe you can jump on that.
Yeah. I think there's a variety of things that go into this, and we've already given you some compliments on the workflow that we've established with you and being able to collect what we need. And I think that's really the number one thing that goes to it, is establishing that really strong relationship with the fund manager and partnering with them so that they understand what they need to be providing in what time frame, so that we can produce investor reporting on the 20th of every month, so that investors know what to look for and what to expect, et cetera. I think the portal helps a lot, but also a big part of being a fund administrator that's focused on the asset types and areas that we are is that we understand the accounting and like templatizing how things can be done, so it is consistent from fund to fund. And so I think that if we can establish that strong relationship and process upfront, we're able to meet the investor expectations.
Yeah.
Well, yeah.
Yeah, I feel like it's one of those things where nobody knows about the fund admin. I mean, they want to hear there's a fund admin involved, but they don't really know what's happening until the statements are late, and then the fingers start getting pointed.
It's kind of like the referee of the game, right? It's like if everything's going well, nobody really notices them, but when they make some bad calls, then all of a sudden they're the villain. So
that's a good analogy. All right, so this is more of a question for fund managers, and especially fund managers that are scaling. So over the last 3 years, we've successfully raised, we're coming up on 100 million in the fund. Now, a lot of people say that was scaling pretty quick, but keep in mind that we were running a trust deed shop since 2008, so we had that kind of investor bench. We had a pretty deep bench of investors that went from that trust deed model to the mortgage fund model, and we were able to kind of utilize the processes that we already had in place. But if you were to say like fund managers today, while you're scaling, what are the common mistakes that you guys are seeing, or things that you would say, hey, stay away from this or do that to make sure that you are successful moving forward?
Yeah, I mean, there's a lot of mistakes. Made many myself, seen many mistakes from people. I think, going back to what we talked about.
And you've seen it. You've gone through not only just mistakes, probably process-wise, but through ups and downs of just the real estate industry.
Yeah, I mean, I think that there's all kinds of mistakes that managers can make. From a fund perspective, I'd say the original sin would be having a bad structure in the first place, or not understanding what the structure is and mismatching the asset model to, private lending's, and some of this is because I know it so well, right? I've done it myself, many times, multiple times running my own funds, and we've done dozens and dozens and dozens of mortgage pool funds, but there's different types of funds, right? So not everything is created equal. So setting it up properly in the first place, Brock, is kind of the first thing that people need to do. I'd say not understanding how and where they're going to raise capital is a huge issue that people face, because there's different types of fund structures for different types of investor bases. Are you going after high net worth? Should it be a Reg A fund? Are they accredited? Are they not accredited? Are you going after family offices? Are you trying to go institutional? I think there's a huge, in my experience, there's a very how do I phrase it? The managers overestimate their ability to graduate into the true institutional space, pension funds, and those kinds of investments. That's very difficult to break into as a small manager. The size and scale of the assets they need to put out are so big that it's usually not going to happen. So oftentimes when people are structuring in the first place, they have a misconception of what their investor base is going to look like, which causes them issues, on the very front end.
Matt, are there specific examples that you could give, like stuff where it works maybe in I'll call it retail. I hate to use the term retail, but like prior, versus institutional world.
Yeah, I would say I've seen managers set up funds that were set up with an institutional investor in mind, but that the structure of that fund just doesn't really work for retail investors. But they either came out of an institutional setting, or maybe they engaged in a lawyer who's more familiar with institutional funds, but you're targeting something different than what that fund is. So, I mean, specific examples, Brock, or nothing. I mean, I've just seen it so many times, it's hard to say. I think that the knowing your investor base and matching your fund to that investor base and to the asset model is probably the single most important thing at the outset of the fund.
Yeah. I agree with you on that. I think, if I go back and I think of the changes that we would have done in the fund, some of the distributions would have been a little different because they don't really match for the debt, for a debt fund on some of the distributions. And, as you grow a fund, it gets more and more difficult to make modifications to the PPM. We're at about 310 investors, and trying to get everyone to explain it to everybody and then get approval from everyone is much more difficult than if you just had 5 investors.
Yeah, and it depends on how your documents are written as to what things require approval and what things don't, right? Statutorily, there's things that always require approval, such as changing to the economic structure that are to the detriment of the investor. But there's other things that aren't necessarily don't require their approval. So again, if you set the documents up properly in the first place, the manager should give themselves flexibility to make changes that don't negatively impact the investor from a financial standpoint. As we're sitting here, I mean, other things are, coming into my mind on mistakes that people make. I think distributing money when they don't have the income in the fund to distribute it, and then it becomes a return of capital, which then, but from the manager's perspective, but my investor just wants to see a distribution. Yeah, but you didn't have any income in the fund to distribute. So if you're distributing, you might have cash, but cash is not the same as income. Right. So there's a lot of confusion oftentimes with managers between, because they don't fully grasp the accounting concepts that apply to a pooled investment fund. I see a lot of managers, that do individual deals and that syndicate, that when they're setting up and thinking about running funds, they don't appreciate the differences between a pooled investment fund and an individual deal. Right. Mm-hmm. So there's a lot. And when they don't appreciate that can lead them to doing things that are just not in comport. They just don't comport with the documents. And they're not doing it to rip anybody off, right? They're just doing it because they don't understand. So there's a lot of that goes on, especially with newer managers, right? Newer and smaller managers, as you said, right? I always use the analogy of having kids, right? If you've never had kids before, you can babysit your niece and nephew, you can read parenting books, you can, watch movies about, what it's like to have kids, but you don't really know for sure what it's like to have kids until you actually have them. And then once you have them, there's an infant, and then there's toddler, and then there's elementary, and there's different stages, right, of having kids. It's the same thing with running a fund, right? You think you can prepare yourself as best you can, but you're not going to fully understand all of the implications of running a fund until you actually run it. And then as you go through, and this, right, as you go through various stages, the new things emerge that you didn't fully appreciate previously. And you look back and say, well, God, I wish I would have done this slightly different. Right. And I've got other analogies that I use, like a house, right? It's like, hey, I should have put the kitchen over here instead of over here. The sun comes in, right? You don't figure it out until you do it.
Yeah. As a father of a 16, 14, and 6-year-old, I appreciate that analogy. All with different personalities.
Yes.
So I'm going to jump in. We got a couple more questions in. These are great. So we got a little more clarification. What is the difference between a private lender and creating a fund? Let me kind of jump on that. So the difference is a lender is going to obviously provide financing for you. If you're trying to create a fund, you have the option out of the fund to, and I know who's asking this question. If you're looking to buy a house to flip it, you could raise 100% of the proceeds in the fund and buy that house with the proceeds in the fund, and then give some type of distribution or whatnot out of the fund. Or you can leverage a private lender. You could raise money in the fund, raise money for the fund that purchase with a private lender, and have the capital from a mortgage fund, or from not a mortgage fund, but a real estate fund, to fund the difference. So you kind of use both hand in hand, similar to what you're doing right now, but the fund is actually created a more, I wouldn't say professional structure to it, but you're not just bringing in investor, your friends and family capital. Next question is the concept, this is more specific to our fund, is the concept of share price relevant to TaliMar Income Fund? Yes and no. Yes, every shareholder, we'll call them shareholder or LP, purchases a share within the fund, and there's a set price to that fund. But as a debt fund, or as a private debt fund, that share price doesn't really move like you would have in a publicly traded REIT. So that, that share price typically, unless you see some significant loss in the fund, you shouldn't really see any movement in the share price. But I'd be more.
I would say, sorry, Brock. I didn't mean to interrupt.
No, go ahead. Go ahead.
Typically in a mortgage pool fund, you're distributing 100% of the income every period. So if you're starting with a share price of 1,000 a share or whatever, right, you get income in the period, you distribute back down to 1,000, and that share price stays pretty static. It can adjust. Like, let's say you have a loan that goes bad, you lose some money, and you take the hit to the income. You might have to mark that down slightly on that share price before you actually take the realized loss. So that share prices can change in mortgage pool funds, but they tend not to change very much, if at all, especially if your assets are performing. So yeah, that's what I would say.
Next question here is: newly admitted real estate attorney with a background in finance, wanting to gain knowledge and find ways to get involved in fund formation and fund management. What are your top resources for gaining knowledge, books, podcasts, etc.? And where do you see the highest need for attorneys during the formation and management of a real estate fund?
I'd have to think about that, and I'd certainly be happy to chat with whoever asked the question if they want and have a more in-depth conversation. But I mean, there's a reasonable number of lawyers that specialize in this industry and form a lot of funds year in and year out. Like, where they gain that specific knowledge, I'm not 100% sure. Not being a lawyer, I'm not sure. But I mean, there's plenty of things on the internet if you look up, funds and fund formation, fund creation, etc. I don't know of like podcasts. I mean, we've put out a fair amount of material on that topic over the years. Short answer, I'm not 100% sure, but happy to talk to whoever that is.
Yeah, you can go on YouTube. I'm not going to say that YouTube, all the content on there is correct, but there's a lot of information, available information, free information that you can learn about. And then, I highly recommend reaching out to Chris and Matt. They'd be more happy to point you in the right direction. All right, so we've got about 10 minutes left. We're going to kind of go through our final questions here. This is more for kind of an investor. What would you say would be the red flags if an investor is doing their due diligence on a fund? What would be kind of some of the red flags that you would say that investor could kind of see before investing, and not making, not going into a fund that might have issues?
Yeah, I'd say it can be very difficult for individual investors putting in, 50, 100 grand, at the retail level. It's very, very tough. That's one of the things about private funds that can be challenging. I do think if people could look this up online too, but there's lots of DDQs, due diligence questionnaires, that have a lot of really good questions on them, that I would suggest people just Google that and find a DDQ, and you'll find 50, 100 questions. Many of those are institutional, and a lot of times those managers will not be able to produce all that information. But simple things like, to your point, Brock, do you have a fund administrator? Is the fund audited? Right? How long have you been around? Do you have a track record? Can you share that track record with me? Has that track record been corroborated by anybody independent of, because the manager can give you a spreadsheet that frankly all the numbers can be completely made up, right? So being able to find information that can be corroborated by third parties is always useful. That can be tough. Do they have a background check that they can share with you? Because like every individual investor is not going to order a background check, but good managers will have a background check that's already been done that they're willing to provide. Do you have a DD or like a DD room? Because to me, a quality manager knows there's 10, 12, 15 questions every investor is going to ask, right? And you probably already do this, Brock. It's like you know what those questions are. You have that information. It's all there. You make it available to them because you don't have to wonder what question they're going to ask, right? But if I'm the investor, what question should I be asking? Again, to your point about the YouTube, there's lots of stuff online that will give you lots of questions that you can be asking, managers, and some of the simple ones are what I just rattled off.
Yeah, I think one thing I would add there, and I wouldn't say it's necessarily a red flag, but as an investor, really making sure that you understand your goals before going into a fund.
Yeah, I would
For
agree.
example, if you're like looking for income, I'd probably want to invest in a direct real estate value add rehab fund that is not going to generate that income for several years. That's more of like a growth play, et cetera. And if you are seeing a manager that's trying to convince you to invest in their fund, but you're not seeing that it's matching your goals, then to me, that's a red flag. You should make sure that the partnership or the goal alignment is there.
Chris, that's such a good point, because when I talk to investors, I always open it up as we're a fixed income investment. Okay.
Mm-hmm.
And so that's what you're going to get. We're not rolling the dice here and going into some equity investment, which, yes, the returns are probably going to, the opportunity for the returns are much higher. And I think that right away kind of sets the table, sets the tone of where that conversation is going. Just yesterday, I was on a phone call with a prospective investor. Actually spent about an hour and a half. And what was really fascinating was he's a CPA for a publicly traded company. So all of his questions were more, audit related and accounting related questions. But he brought up, I would say, like the 5 questions that he brought up that were really important. Number one, again, who does your accounting? Okay, that came up absolutely. What are your processes and procedures? So it's really important as a fund manager is to make sure that you have a processes and procedures in place, and that they're continuing to look at that so that the fund is run efficiently. And that's something that we really press upon within our company, is reviewing our processes and procedures and making sure, look, if Brock isn't there or my director of operations isn't available, is it pretty set in stone what the processes are to do something within the organization? And that's something that we really have focused on, because I think a lot of investors get concerned that you've got one guy running the whole shop, and if that person disappears, then how is that going to be run? And then number 3, I recommend, I tell every investor, go in and meet with the fund manager, either in his office or have some type of web conversation with the team. And we offer that to all of our investors, and I think it goes a long way to get people to feel comfortable that you've got a team around you that can operate in an effective manner. Or kind of those are like kind of the main things. And if the fund manager can't answer those questions or do that type of stuff, that should be a red flag. The other thing is you can ask around. I mean, there's plenty of other resources and people that probably know that fund or that fund manager that you can talk about. Especially, we being here in the San Diego market, everybody knows TaliMar Financial in the San Diego market. They can give you some kind of real world feedback on how we operate. So that would be my thoughts. And there's actually some also great organizations out there that you can attend. California Mortgage Association, CMA, is a great organization to become involved with. They specialize in the private lending industry here in the state of California. You've got American Association of Private Lenders, AAPL. Then there's some other events that you can also go to and be involved with. And you can get some background on all these fund managers. Excuse me. So with that, I think we've answered all of the questions that have come in. I'm going to give it the stage to Matt and Chris again to kind of close it out. Tell us a little about Verivest and how you can help investors and fund managers get involved in investing in funds and then also establishing and getting their funds up and running.
Yeah, no, thank you, Brock. I think I would characterize Verivest as a boutique fund advisor and administrator. So anybody that's thinking about setting up a fund or getting started setting up a fund or running a fund, we can provide advisory, coaching, for the manager on various aspects of running that fund, and then do all the things we've talked about here today on the admin side, doing the back office accounting, helping on the front end with the investor relations, et cetera. And we can customize the scope of services depending on the manager. Some people want the whole suite. Some people want only certain things a la carte, and we're happy to talk about that. But if you're in real estate, mortgage pools, private credit, that's really our sweet spot. We certainly can do private equity some VC as well. Hedge funds, not nearly as much, but yeah, that's who we are. If you're looking for the big name, Big Four, or the white shoe, equivalent law firm in the fund admin space, there's definitely large fund administrators that have those names. But that's not us. We're going to be a more hands-on boutique, attentive manager, kind of in a subset of the fund world, like I just described. So that's how I would characterize us.
Yeah, and I would encourage anybody that maybe you're not ready to look for a fund administrator yet, or you want to build a fund in the future, or maybe you're moving from syndication world to the fund world. Follow Matt on LinkedIn. You can follow us on our website, verivest.com, and sign up for our newsletter. We're going to have our own webinar series that kind of walks fund managers through, should you start a fund? What should you think about when starting a fund? And we'll have some experts from different fields join us on that journey.
And I'm going to follow up with both Matt and Chris's contact information on a follow-up email, so you guys can reach out to them directly with any questions that you have. But I will end it in just saying, Chris, Matt, everybody at the Verivest team have been instrumental in the success of our mortgage fund. We look forward to a long relationship with you guys. I kind of mentioned this earlier. I feel like you guys are kind of the forgotten, unknown people in the background until something is off, and then all of a sudden fingers are pointed at Verivest. And I'll do it too, just to throw you guys under the bus sometimes, because I don't want to deal with it. I say that just jokingly, but but you guys know you guys have done a great job over there, and we're excited to be working with you. And again, thanks for coming on and sharing your thoughts about fund administration.
We appreciate the opportunity, and it's been great chatting with you. Thanks for having us.
Thanks, Brock.
All right, with that, thanks everybody for attending. Like I mentioned before, we're going to go ahead and post a recording of this video on our YouTube side. Also share it with Chris, Matt, and the rest of the team over there. So if you missed it or wanted to cover or review some of these topics that we covered, check out the video. But thanks again for attending.
Thank you.